So, very good afternoon, friends. I hope you made your revisions of what we did yesterday. So, let me tell you the focus for the day. I guess we decided we'll do questions on investment appraisal today. So, what we're going to do, as usual, we're going to first of all make some quick revisions of the concept, and then we'll do some questions on investment appraisal. So, I'm going to first give you my approach in terms of doing investment appraisal because I know many of the new students who have not studied from me are also there. So I think before we start with the inputs, I'm just going to give you a quick recap in terms of how we're going to approach a question on an investment appraisal on a step-by-step basis. So let me share the Excel sheet to you. And let's, I think, first of all, pen down how we're going to approach an investment appraisal question. Well, when I'm looking at an investment appraisal question, my focus is typically on a question which is asking you to calculate an NPV. Now, my input is that when you handle this kind of a question, we're going to follow a simple three-step model. Go on a step-by-step approach and you'll never ever go wrong. Now, what is the three-step model we're going to apply when we're going to calculate the NPV of a particular question? I would say the step number one is that you need to first of all identify in a question that is there any inflation rates given in the question? Because some questions you will find that inflation rates are given, and some questions you will find that there is no inflation data. So the first thing you're going to identify is that is there any inflation? Is there any inflation data given in the question? Now, if you're given the inflation data, so the possibility could be a yes or the possibility could be a no. Now, let me ask you, if the inflation data is not given, then of course, I'll tell you, I'll directly go to the step number two, then there is no problem. But tell me, if the inflation data is given to me, are you going to consider the money cash flows or the real cash flow? Unless mentioned otherwise, are you going to consider the cash flows on money terms or on real terms? That's right. So we are going to organize. We will organize, you can say MCF. That's called the money cash flow. And are you going to consider the discounting rate, which is MDR, or is it going to be RDR? A money discount rate, or are we going to consider RDR? That's right. So we are also going to organize, you can say the MDR as well. Now, let me also tell you one thing very clear. It is always a preferable approach that you should always organize MCF at MDR. Though, if you discount the RCF at RDR, the results are same whether you discount MCF at MDR. But let's say you are given a specific inflation rate for, let's say, material, let's say labor, etc. So is it more appropriate to use MCF at MDR, or are you going to use RCF at RDR, considering that a general inflation rate is given, considering that we're given specific inflation rates for sales, for material, labor, etc. It is always preferable that you should organize MCF and you need to organize MDR. So your first focus in any question will be to see if there is any inflation data given in the question. And if yes, it's better to organize MCF and MDR. Then we'll go to the step number two. And in terms of step number two, we'll divide this in terms of two subparts. Now, you need to carefully go through the question and see that if there is any working capital information which is given in the question. So if there is any working capital information given in the question, so see if there is any working capital information, we'll organize the working note with reference to working capital information. Now, a quick question. When you say that there is a working capital information, what is the timing factor when the outflow for a working capital takes place? So what do we assume? What is the timing factor in this case? Is it at the end of the year or is it at the beginning of the year? And that's right. It is always considered to be the beginning of each year, unless mentioned otherwise. We need to assume that working capital is introduced at the beginning of the year. And do we assume 100% recovery? Because working capital which is introduced at the beginning of the project, can I say there will be 100% recovery at the end of the project? Yes, of course. Then I would say you organize the step number 2B, in which you need to calculate your CFAT. That is your cash flow after tax. Now, let me remind you, when you calculate a CFAT, there are two alternative ways in which you can organize your CFAT. One is that you consider a PAT and you add up the depreciation as it is or net of tax. When you're going to consider the CFAT, so you're going to consider the PAT plus the depreciation. So you're going to add the depreciation as it is or net of tax. I'm afraid it's not going to be net of tax. It's going to be added as it is. So when you consider the CFAT, we take a PAT plus a depreciation without taking the net effect. The second alternative approach is that you can consider PBDT minus the tax. That is the tax on the PBT. Now, ideally, you're free to use any approach you want, but I think there is going to be a specific situation where we would prefer the two alternative. I would say that if your tax is in arrears, then which approach do you think is more preferable in nature? I'm saying preferable, though you can do anything. But if there is supposed to be a tax in area, we're going to use a second alternative. So if in the question the tax is in arrears, then we are going to use the second approach. Though technically speaking, it doesn't make a difference, but I think it is still preferable to use the second approach. Then finally, we go to the step number 3. And in terms of step number 3, now it's time to organize and calculate the net present value. Just to give you the basic inputs, when you go to consider the NPV, we would need the discount rate, or we can say that we would need, you can say the cost of capital. The discount rate can also be called as the cost of capital itself, or you can call it as a WACC, what we've already seen yesterday. Now, this discount rate is going to be what? MDR, because that you've already organized earlier. Now, let's also come to some more inputs. When you calculate the NPV, there are certain cash outflows. Would you like to tell me what are the cash outflows? What elements are considered in terms of cash outflow? I guess number one, you're going to consider capital expenditure. The first is the capital expenditure, right? Or you can call it as the capital investment. And this will be at time zero unless mentioned otherwise. And the second is going to be the working capital, which you have already organized, in your step number 2A. So this information you're going to get from the step number 2A itself. So go systematic and trust me, there will not be a problem. Similarly, when you're going to organize the cash inflows for the NPV statement, so what are the various categories of cash inflows which you're going to consider? That's right, one is the CFAT, and the CFAT is what you've already organized in terms of step number 2B. And what is the next input? Apart from this, we're also going to consider another input as well, and that would be, you can call it as a terminal value. Yes, so we can say there will be a terminal value, and when you consider a terminal value, there will be two elements of the terminal value. Number one, we would consider the scrap value of the asset, and number two, we're going to consider the recovery of the working capital. So we're going to consider the recovery of the working capital as well. Now, one more input which you need to keep in mind, that when you consider the scrap value, can I say in this particular case, it would be as per what is given in the question. But when it comes to recovery of working capital, it is going to be 100% unless mentioned otherwise. So these are certain key considerations which you need to keep in mind. Solve it on a 3-step model. First, you need to organize your MCF, MDRs. Then you need to organize in step number 2A, the working capital, and in step 2B, the CFAT. And then you just need to fit in everything in the NPV statement. And just in case, if you get a positive NPV, we accept. If you get a negative NPV, we reject. And if it is, let's say, 0, it becomes an indifference point where we may accept or we may reject the project. I guess so far so good. I think we are done with the quick revisions on the calculations of the NPV. Now I think let's go to the larger question with you. I am now going to share a question to you on the screen. Let me know if this is a question which you've already done or is this a new question. If it is new, then it's good. If you're done, then it's a revision again. Done earlier. Uh-oh. So let me see how many of you have done this. No, I think yes. Some people have done this, and I think very few people have not done this question earlier. Okay. So we'll get answers mainly from those who have done this question, but let's get more proactive answers for those who have not done this earlier. Let me now read the inputs in the question. I would advise that generally when you get a section C question, the first thing you should always do is look at the requirement of the question. It's a good idea to first read the requirement because accordingly you can start thinking. It says calculate the NPV of the investment project in nominal terms. Nominal term means money terms, and comment upon the financial acceptability. And then the second part is the theoretical part. So we're focusing on the NPV calculations. Now let's, I think, read the inputs. It says H company is preparing to launch a new product in a new market, which is outside its current business operation. The company has undertaken a marketing research and test. Now, there is a few more inputs, which is coming to my mind, which I think we can pen it down as a concept as well. Now, when you calculate the NPV of a given project and you consider the inflows and the outflow, my next question is, do we consider inflows, outflows based on relevant data? Do we need to filter the inflows, outflows in terms of what is relevant and irrelevant? What do you say? So the project will be evaluated on the basis of inflows and outflow. And yes, it's going to be very important to filter what is relevant and irrelevant. So when you're going to consider the cash inflows and the cash outflows, so in this particular case, what we'll do, we will filter what is relevant. We will filter what is relevant and what is irrelevant in nature. Because whatever is irrelevant, that would not be taken in the decision making, which means when do you decide relevant and irrelevant, you need to put a very simple question. If you accept a project, you will incur that cost, otherwise not. So that means it is relevant. Now, if you say whether you accept a project or you don't accept the project, you will incur the cost irrespective, then it becomes irrelevant in nature. So as we're going to read the data, you also need to filter that what is relevant inflow outflow and what is irrelevant inflow outflow. Now let's come back. So it says the company has undertaken a marketing research and test marketing at a cost of 5 lakh and a result of which it expects the new product to be successful. Is this money yet to be incurred or is this money already incurred? He's telling you the company has undertaken a marketing research and a test marketing, and they've reached a conclusion that it's going to be successful. So they've already incurred this money. And if they've already incurred this money, is this something which is relevant for my NPV or is this something which is irrelevant in nature? That's right, it becomes completely irrelevant in nature because you've already spent the money. Now, whether you are going to run the project or not, the money has already been spent. It's down the drain. It is called sunk cost in nature. Now, the question also is, it'll be a good idea that, when you ignore these kind of costs, you should also give a note to the examiner that this kind of cost is being ignored. It's a good idea. I know you will not take this in the analysis, but giving an explicit note would be a more appropriate thought. Then he says H plans to charge a lower selling price initially and then increase the selling price on the assumption that new product will establish itself in the new market. The forecasted sales in terms of units are given, the selling price is given, and the variable cost is given. And then he adds on a very interesting input. It says selling price and variable cost are given in current price terms before taking the forecasted inflation, which is 4% for sale and it is 5% for the variable cost. So is this data in terms of RCF or is this data in terms of MCF? He's very clearly saying that, we have taken this all in current price terms, ignoring the inflation. So it is RCF. So we'll have to organize this data in terms of money cash flows as well. Then he tells you incremental fixed cost. I guess that word itself is indicating that is it relevant or irrelevant for decision making. The word is incremental. Incremental means that you will incur this cost if you accept the project, and you're not going to incur the cost if the project is not accepted. So this is definitely relevant to take a decision. Then he says the incremental fixed cost is also in current price terms and would arise as a result of producing the new product. And we're also given the inflation rate, which is 8%. Now, just in case, since to connect the dots, we're given a specific inflation rate for the selling price, a specific inflation rate for the variable cost, a specific inflation rate for the fixed cost. Does it make all the more sense that we should use MCF and MDR? Because we are given different inflation rates for different elements. So it makes complete sense that we must use MCF at MDR. Then he says initial investment of the cost of production for the new product is 2.5 million, which is payable at the start of the first year. Production will cease at the end of 4 years. That's the life of the project, because the new product is going to become obsolete due to technology. The production equipment would have a scrap value at the end of 4 years in future value terms. So is this 1,25,000 MCF or RCF? It very clearly says that it is in future value terms. So is this supposed to be MCF or RCF in amount? So what do you say, MCF or RCF? It says in future value terms. That's right, it is MCF in amount. Then he says investment in the working capital, and that is 1.5 million will be required at the start of the first year. Working capital inflation is also given, and there will be a recovery in full at the end of 4 years. Even if the question is silent, the recovery is going to be done at the end of 4th year in any case. Then he says ABAC pays a tax at the rate of 20% with a tax liability settled in the year in which it arises. That means tax is not in arrears. The tax is paid in the year in which we are supposed to pay. The company can claim a tax allowable depreciation 25% WDV on the initial investment cost, adjusted in the final year of operation as a balancing allowance or a balancing charge. In fact, I would also add another input out here. I think it's a good point that in terms of step number 2C, I would say you can also organize something more. Just organize the terminal value of the asset as well. So it'll be great that if we can add another step number 2C, wherein you can organize the terminal value of the asset. Now, at this stage, let me also make a quick mention at this stage. Many times the student gets confused looking at solutions in the book that do we consider a depreciation in the last year or not? If in the examination you are stuck up and you're thinking, whether we take a depreciation or not, ideally speaking, we should not take a depreciation in the last year. We should be calculating a balancing allowance or a balancing charge. And trust me, even if you land up taking a depreciation in the last year, your final answer would still remain the same. Ideally speaking, you should not consider a depreciation in the last year. You should only consider balancing allowance or a balancing charge. Then he says H company has got a nominal after-tax weighted average cost of capital 12%, that's MDR, and a real after-tax, which is 8.5, that is supposed to be RDR. The company uses a current WACC as a discount rate for all the investment projects. Great. Okay, so first I think we'll discuss the A point. We'll do a little discussions on the B point as well, because I think this is also going to be pertinent based on our discussions yesterday. I'm sure you would have well understood the entire data in the question, so we can start working on this. So then we are supposed to mention an explicit note that depreciation is not being considered for the last year. If you can put a note, it is better. It is a good point to give a disclaimer in the question. You can tell that we have ignored the depreciation in the last year, and accordingly, the amount of balancing charge allowance gets taken. Add on into the note, alternatively, the company could have taken a depreciation in the last year, and then the figures of balancing allowance or charge will accordingly change, and then make a mention that irrespective, the results will remain the same. It's a good idea, I think, to definitely put a note across. All right, friends. So I think, are we ready now to solve this particular question? Going with a step-by-step approach in this case? You're welcome. Okay, let's, I think, start. So this is my question number 1 for the day. So I'm putting this as question 1. This is by the name, I'll put the name of the question, ABAC. Okay, so we're going to go first of all step by step. As we said, this is on investment appraisal, that is on the NPV calculation. So we're going to go with step number 1. Now, step number 1 is that we need to organize. Step number 1 is we need to organize MCF and MDR. So we need to first of all organize MCF and MDR. Now, let's do one thing. Let's first focus on the MCF data. Every information is to be organized in MCF terms. Now, one thing is either you organize this in step 1 or you organize this in terms of step number 2. When you go to calculate the CFAT in step number 2B, either you organize it there. My advice is organize it here itself. So let's do one thing. Let's organize the sales data. So I'm going to first of all organize my sales data. Let's take a column for particulars. So we take a column for particulars. And how many years is the project life? I guess the project has got a 4 years life. So let's do one thing. Let's take year 1. Let's take year 2. Let's take year 3. And let's take year number 4. So we need to organize the data for a period of 4 years. So as far as the sales data is concerned, let me first organize the volume. That is the units. So we just first copy the volume data. So if you look at the volume data in the question, I am given the volume is 2 lakh, 8 lakh. So this is 2 lakh. This is 8 lakh. And then we are given 9 lakhs and 4 lakh. So this is the sales data with me. And then let's consider the selling price, which is per unit. Now, remember the selling price which is given in the question is to be converted in MCF term. So I am given 1518. Let me just note it down. So we are given this is 15 and this is 1822. This is 1822 and this is 22. So let's make a mention in the bracket that this is supposed to be RCF figure. So this is my RCF figure. Now, I am also given the inflation rate as well. We are also given the inflation rate. So let's see what is the inflation rate for the sales. It says the forecasted selling price inflation is at the rate of 4%. Now, let's organize the selling price, which is on a per unit. This is on the MCF terms. Now, help me in terms of organizing this in MCF. Can I say 15 into 1.04? Can I say for the first year, if you want to calculate, it's going to be 15 into 1.04, correct? So we can take this 15 and this is going to be multiplied with 1.04. You get the answer 15.6. Now tell me for the second year, are you going to take 18 into 1.04 or are you going to take it raised to power 2? Compounding twice. So when you're going to consider the selling price for the second year, compound it twice. So we will take this as 18 and this will be multiplied into 1.06 raised to power 2. And similarly, we can organize for the third year as well. So this is going to be 22 and this is going to be multiplied with 1.06, 1.04 raised to power 3. Is the second one done correct? I took 4% only. No, this is 4%. Right, I think I rectified that. Yes, thanks for the correction. So this is done. This is at the rate of 4%. Then similarly, we can take 22 and this is going to be multiplied with 1.04 raised to power, that is 4. Right, so this is the selling price which is computed on the basis of MCF. We've compounded the data. Now let's, I think, organize the sales data. Now, technically speaking, a lot of things comes to the mind of the people. So let me also clarify. If you want to calculate the total sales, you can. If you want to calculate the total sales, you can. Otherwise, it is also possible that you can take the selling price minus the variable cost and get the contribution. And then you can multiply it with the volume at a later stage. So that's your choice. You want to organize the sales in terms of complete value, you can do that. You want to take a contribution later, you can do that. So I think, what do you want? Should I organize the sales, or you want me to go with the contribution data? Either of the two, because irrespective, it's going to work. Okay, so we'll take the contribution later. Done. So let's now organize the variable cost data. So now we're going to organize the variable cost data as well. So let's see what is the variable cost per unit. So in terms of the variable cost, it is all 999. So variable cost per unit is all 9. So this is all 9. And we are also given the inflation rate. The inflation rate for the variable cost is defined, and that's at the rate of 5%. Now I think it's going to be a little more simpler. We need to organize this. Let me leave a space. We just make a mention that this is RCF terms, and then we organize this in MCF terms as well. So now it's going to be easy because the variable cost is common all throughout. So can I say we can take this 9 and compound this at 1.05 raised to power 1. Can I take this 9.45 itself and multiply this with 1.05? Can I take the first year figure and just compound it at 1.05? Yes, I can. So we'll take this figure and we're going to multiply this with 1.05. This is raised to power 1 only. Now don't raise it to the power of 2. Because if you're taking the previous year as base, then just once. Similarly, we can take this previous one as a base and multiply this with 1.05 raised to power 1 again. And similarly, we can take this one as a base and multiply this with 1.05 raised to power 1. So this organizes the variable cost data as well. Let's see if there is any further data which is to be organized. So sales data organized, variable cost data organized. Anything else? I guess we've got an incremental fixed cost as well. So we need to organize the fixed cost data also. So let's take the fixed cost data. So in terms of the fixed cost data now, we are given the fixed cost, and that is again in RCF terms. We'll convert this by using the inflation rate. And the inflation rate is given to me. It says inflation rate is 8% for the fixed cost. So this is at the rate of 8%. So what is my fixed cost? It says the incremental fixed cost is supposed to be 5 lakhs per annum. So we take this 5 lakhs throughout. So this is 5 lakhs throughout. So since this is also a common figure, you can organize the information the way you've done it for the variable cost itself. So let's see what is the fixed cost in terms of MCF terms. So can I say we'll take this 5 lakh as a base into 1.08 raised to power 1. So we can take this 540 as a base again. So we take this 540 into 1.08 raised to power 1 again. And we again take this as a base. So into 1.08 raised to power 1. And again, we take this as a base. So this into 1.08 raised to power 1 again. I hope the calculations are correct. So I think all the information, sales, variable cost, fixed cost, all the data gets organized in terms of MCF. Anything else which needs to be organized in terms of MCF? What about the depreciation? Is the depreciation also required to be converted in MCF terms, or will the depreciation data remain the same? What do you say? So do we need to convert the depreciation data also in terms of MCF, or would that remain the same? Yes, that would undoubtedly remain the same. That doesn't undergo a change. So I think we are done with organizing MCF data. Now let's go organize the MDR as well. So I think the MDR position is already given in the question directly. So if you go back to the last para, it very clearly tells you that it is 12%. So MDR is already given to me. It's at the rate of 12%. Okay, trust me, once you've done all this, the life is going to be simple. Now this is step number 1 done. Organize the MCF and the MDR. Then we go to the step number 2A. What do you do in step number 2A? Organize the working capital information. So now we're going to organize the working capital information. So let's see what is given for the working capital. It says investment in the working capital is 1.5 million at the start of the first year, and the inflation rate is also 6%. There is no incremental working capital per se. But let's first organize the working capital data. Now tell me, when you go to consider the working capital, I think I'll just put it according to year. Should I start with 0 point of time or year 1? Because whatever is the working capital, that would be pertaining to 0 point of time. Though right now you can say year 1 to 3, I don't have a problem. So maybe you can write year 1 to 3, that's fine. But later we need to remember when we come to the NPV statement that this is going to be introduced at the beginning of each year, and this is going to be recovered at the end of the fourth year. So let's consider the year 1, 2, 3, 4. Now let's first take the working capital, and this is in RCF terms. So what is the amount of working capital? 1.5 million. That would mean 15 lakhs. So this comes to 15 lakhs. And can I say technically there is nothing else which is given further. So this is 15 lakhs. Now we are also given the inflation rate as well. So what is the inflation rate for the working capital? I guess the working capital inflation rate is at the rate of 6%. So let's get the working capital based on MCF terms. So let's consider this 15 lakhs. Okay, now when you go to consider this 15 lakhs, so are we going to apply the inflation rate to this 15 lakhs? This is what you're introducing at time 0. So are you going to consider the effect of inflation on this? I'm getting some mixed divided opinions on this. I think since this is being introduced at time 0, this is already in MCF terms. So this remains 15 lakh. So can I say we will compound it at the end of this year? So 15 lakhs. Now tell me, multiplied with 1.0806 raised to power what? Though it is written second year, but it is at the beginning of the second year, which is as good as the end of the first year. So this is going to be raised to power 1. That's right. Then let's see the other figure. You can again take 1590 as a base into 1.06 raised to power 1. And then again, this is going to be the previous year figure into 1.06 raised to power 1. Okay, so I think this gives me the answer. Is it necessary to do raised to power 1? Otherwise, I think you'll not get the data, because if you want to calculate the figures, raised to power 1 will be done, because you're doing compounding. So Excel would need raising it to the power so that it will calculate the figures immediately. Okay, so I think now let me, pinpoint that what will you introduce. So we can say what is the introduce, how much you will introduce as a working capital. Let me put this down time 0. Then we can say time 1, or maybe let's not confuse this at the moment. Let's just see what will be introduced. You will introduce 15 lakhs in this case. You will introduce another 90,000 in this case. And what is the difference between these two? You will introduce the difference between these two. that is 95,400, and you will also introduce the difference between this and this figure, and tell me what will be the recovery. Tell me what will be the recovery. Can I say the recovery will be how much amount in the fourth year? Is this the amount which you will recover? Correct. So I've just identified how much will get introduced at the beginning of each year and what will be the recovery. So I think I'm just going to make a small little mention that this is going to be introduced. This is what we're going to introduce at the beginning of each year. So this is introduced at the beginning of each year. This is what you're going to introduce at the beginning of each year, and the recovery is going to take place, can I say, at the end of each year, at the end of the year. This will be at the end of fourth year. Right. So I think this gives me the working capital calculations as well organized with us. So that, once we go to the NPV statement, we don't need to apply much of our thoughts. Okay, step number 2A is done. Now let's go to the step number 2B. Let's go to the step number 2B. Now, what is step number 2B? Can I say we're going to calculate the C fact? So my step number 2B is going to be the calculations of the C fact. Okay, now it's time to organize all the information which you have organized in the step number 1. Put it here. So let's take a column particulars. And then we take year 1. Then we take year 2. Then we take year 3. And then we take year 4. So first of all, I think let's note down the volume. So I think I can take the volume data from here. Let me just copy that volume data directly. So this is my volume information, which I can fit in. Okay, then I think we have the selling price per unit. Let me just take this above only. My selling price data is out here in MCF terms. We're just going to copy this data. So this is my selling price data. This is done. Then let's also get the variable cost data. That is again MCF values. So we pick this MCF data as well. Correct. So I think now we can get the contribution per unit. And if you want, you can give to the examiner, inputs as well, that this is we're taking as A, and this is what we're taking as B. And you can tell the examiner the contribution is A minus B. That would be a good exercise as well. So let me consider this selling price minus the variable cost. We can stretch this out. So that gives me the inputs. That is the contribution per unit. Okay, so I think once we organize the data, then it's simply, going to be put out here. And then what do? We get the total contribution. Now, as far as the total contribution is concerned, you need to multiply the volume into the contribution per unit. So you need to multiply the volume into the contribution per unit. So I think let me directly calculate this. This is going to be this volume and multiply this with this figure, that is contribution per unit. Okay, and then we can just stretch it out. So we get this data. This is the data, correct. So I hope the data is correct. So I am given the total contribution done. Okay, so far so good. I guess this is done. Now what do? We need to reduce the fixed cost, right? So let me just go back to the fixed cost data. and we can pick up the fixed cost data from here. That is again on the MCF terms. So let's take this and we reduce the fixed cost. Right. And then I think we can get, now tell me, what are you going to get? Are you going to get the PBDT or are you going to get the PBT? Is this fixed cost inclusive of the depreciation? The word used is incremental fixed cost. Can I say if it is incremental fixed cost, that means it is without considering depreciation. That's right. It is going to be PBDT. So we can take the contribution minus the fixed cost and we can get the information out here. This is done, this is done, this is done. Okay, so once we get the PBDT, now we are trying to work on the depreciation. So are we planning to take a depreciation of the last year? I'm not. We're going to consider depreciations only in the first 3 years. We're not going to consider depreciation last year. There we'll take care of the balancing allowance or charge. So let's now go back to the depreciation data. The depreciation rate is given to be 25% on reducing balance method on the initial cost of the investment. So you purchase the asset at what value? It's purchased at 2.5 million. So on 2.5 million, calculate what is the depreciation. So 2.5 million is the cost of the asset with a 25% WTV. So 25 lakhs, 25%, that is going to be 6 lakh 25, right? 25 lakhs and multiplied with a 25%, 6 lakh 25, right? And then you can take 75% of this figure to get the data. So that is going to be 468. You know what you can do is you can take this figure and multiply this with 0.75. Faster calculation. Then you can take this same figure and multiply this with 0.75. And last year, of course, I'm not considering a depreciation because if your depreciation is 25% WDV, so you can take the next year depreciation 75% of the previous year. And now we can get the PBT. So this is going to be PBDT minus the depreciation. Stretch it out and we're going to get the PBT as well. So this is the information regarding the PBT. Okay, so PBT is done. Now we need to consider the tax. So let's consider the tax. So tax, I think, is at 20%, I believe. The tax is given to me, it's at the rate of 20% and it is settled in the year in which it arises. So we need to be careful. The tax in this case is not in terms of arrears. So that means we'll pay the relevant tax year itself. So we can take this PBT into a 20% tax rate. So this will give us the tax calculations as well. And then we can get the PAT. So this will be PBT minus tax. I hope I'm not going fast. Everything is being done on the Excel. I hope that's not fast. Okay, so done. I guess if you're done, then let me know. Then we'll just calculate the CFAT as well. Right. If you're done with the calculations, let me know. Yes, great. Then I think for the CFAT, we just need to consider PAT plus a depreciation. So we'll take a PAT plus a depreciation in this case. Okay. So now in this particular case, if you take a CFAT, it is PAT plus depreciation and you can stretch this to get the figures. And my advice is, though you can also tell me, should we discount these values at this stage? Instead of discounting them in the NPV statement, I think it's a better idea that we discount them at this stage itself. Makes sense. So what was my cost of capital? That was 12%. So let's see the PV factors at the rate of 12%. So let's see what is the PV factors. So P factors at 12%. This divided by 1.12 raised to power 1. Then this is going to be 1 divided by 1.12 raised to power 2. Then this is going to be 1 divided by 1.12 raised to power 3. And this is going to be 1 divided by 1.12 raised to power 4. So that is my present value factors. So we can calculate the present value as well. So this is going to be the CFAT multiplied with this present value factor. Great. So my CFAT present value is done. And I think now we can also take the sum total of the present value of the CFATs and organize it as a total. So we'll put this in the NPV statement later. So let me just take the sum total of this. So this gives me the total. Correct. So this is my present value of CFATs done. So my step number 2B is done. We've done the calculations on the working capital. We've done the CFAT calculations. Then we go on to the step number 2C. So now we go to the step number 2C, and step number 2C is on what? Terminal value. So we need the calculations of the terminal values now. So in this case now, what do? We need to compare the book value of the asset versus the sale proceeds. Okay, if there is going to be a gain, what will you call? Balancing charge or balancing allowance? If you're going to get a capital gains, then it is going to be a charge. And if it is going to be a loss, then it's a balancing allowance in that case. So let's organize now what is the book value of the asset. Can I say for the book value of the asset, we can see the cost of the asset was 25 lakhs, I guess. So book value of the asset was 25, and we had taken a depreciation for year 1, year 2, and year 3. So let me just reduce the depreciation. We're taking the depreciation 6,25,000 for the year 1. I think let me just take this in brackets. So we took a depreciation for the second year, that was 468,750. So in Kaplan book answer, depreciation is not included. Why? Actually, they've got a different technique of solving the question, and I use a slightly different technique. They consider the impact of depreciation separately, but I do it in the CFAT calculations. They only consider the tax saving on the depreciation. So they do the calculations of the CFAT, ignoring depreciation altogether, and then they add the tax saving due to depreciation separately. I prefer that, let's go the traditional way, get the PAT, add the depreciation, and get the results. The results are the same. Irrespective, you follow them. But I think I find this, a little more easier to do. You keep a track, that's easier. So 351,563. So I think this is going to give us a book value. So once we get this data, this is the book value of the asset. So I have not taken a depreciation in the last year. So this gives me the book value of the asset. Let me just copy this out. So we get the book value of the asset. And now let's see what is the sale proceed of the asset. So in terms of the sale proceed, what is the value at which you are disposing the asset at the end? It says that it'll be sold at the end at 1,25,000. So you're going to sell this at 1,25,000. So there is a balancing allowance or a balancing charge. So there is a balancing allowance in this case because we're getting a capital loss. So we'll take the sale proceeds minus the book value, and this is the balancing allowance. Now tell me, what will you do? So once you get the balancing allowance, will this lead to a tax saving or a tax payment? So once you get the balancing allowance, you're going to get the tax saving. Yes, we're going to get the tax saving on this. And the tax saving in this case is on this figure, that is 929. I think I want to, let me do one thing. Let's remove the minus sign. Otherwise, it will create a trouble. So let me do one thing. Let's take this minus this so it remains positive. The tax saving is going to be on this figure at the rate of 20%, 0.2. Now tell me, what is my terminal value? What is going to be my terminal value in this particular case? Is it going to be sale proceeds plus minus what? That's right, sale proceed plus the tax savings. So you take the sale proceeds and to this you add the tax savings. That's going to give us the terminal value as well. Wonderful. So I think this is taken care. So I think my step number 2, ABC, is done. I think now we are ready to fit in all this data in terms of an NPV statement as well. Now let's go to the step number 3. It's all about a step-by-step approach. You just need to organize things. Your focus needs to be very clear that in the first case, if inflation data is given, get the MCFs, get the MDR. Whatever is the need be, the sales, the variable cost and fixed cost, all convert them in terms of the MCF data. So once you do the CFAT statement, everything is well organized. In terms of step number 2A, you need to organize your working capital. In step number 2B, the CFAT, and then the step number 2C, organize terminal value. Now with this, you've got all the information ready, which can be fit into the NPV statement. So finally, we go to the step number 3, which is on the NPV computation. So I think let's now organize the cash outflows and all. We'll take some fixed columns, particulars. So we've got particulars, then we've got time, then we've got PVIF, then we consider the amount, and then we consider the present value. So then we consider the present value in this case. Okay. So now we'll just organize the inflows, outflows, and get the NPV statement. So let's first consider the cash outflows. So in terms of the cash outflows, there are 2 cash outflows we know. One is the investment, the capital outlay, the investment in the project. So let's consider the investment. I guess the investment is at 0 point of time, but the P factor is 1. And this was, I think, 25 lakhs. This is, I think, to the extent of 25 lakhs. So we get the present value, this 25 lakhs into the PVIF. And then there is going to be a working capital. And for this, you've already made a working note. Now, careful. So when you're going to consider the working capital, we know that there is an outflow at the beginning of each year. So can I say 0 point of time, first year, second year, third year. Now let's organize the data from above. Let's go back to the step number 2B. So in terms of step number 2B, what is the working capital introduced at time 0? 15 lakhs, then 90, then 95,400. So let's take 15 lakhs. So this is supposed to be 15 lakhs. Then I think it is 90,000. And then there is more information. This is 95,400. So this is 95,400. And last year, I think it was 101124. So 101124. Correct. So this gives me the status of the working capital introduced. Recovery will be taken in the inflows separately. So P factor at the first point is 1. I think we can take these P factors from above. Let me copy this. So first year P factor. This is the first year P factor. Then let's take the second year P factor. And let's take the third year P factor. Okay, so I think the factors are done. So we can now just multiply this, stretch it. So this gives me the data in terms of the present value terms. Good. I think that's all the outflows which are given. We can just add this up. These are the total inflows. We take this as A. This is what you can call as the present value of all the future cash outflow, discounting them at time value of money. Okay, then I think we go ahead and consider the cash inflows. So cash inflows, CFAT is there. And I think that we can directly take from the working note. That is 2B. So I think we organized that information earlier. We take this figure. So we'll just fit in this CFAT out here. Okay, so this is done. Then we need to consider the terminal value. Then we need to consider a terminal value. The terminal value is at the end of 4th year. And can I say terminal value has got 2 elements? What 2 elements do we need to consider now? So terminal value has got 2 elements. One is the working capital recovery and one is the scrap value of the asset, correct? So there are 2 elements to be taken at this stage. So let's begin with the working capital recovery at the 4th year end. So let's see what was the figure. So working capital recovery, we had computed, it was this figure. Let's copy this. So working capital recovery, we put this out here. And this is in the 4th year. Let's take the 4th year factor as well. This is my 4th year factor. And this is also at the same point of time. Right, so I think this is done. Now the scrap value is there with me. This is the terminal value. You can fit it out here. So once you've done the working notes, then it is all about fitting the information directly. So multiply this into the P factor. I guess that's all. We can just maybe just scrutinize the question and look at anything which is not yet taken. Let's take the sum total of this. And this is going to be B. So this is the sum total of the inflows as well. Okay, I hope the calculations are correct. Did we miss out anything? Is everything taken? I guess let me just scrutinize the question for anything else. So in the initial, the marketing research was given. That was irrelevant data. Then I think sales, volume, price, variable cost is taken. Fixed cost is taken. Initial investments taken. Terminal values are taken. And working capitals all done. Depreciations all done. I think that's it. So now we can get the NPV as well. So we get the NPV, that is B minus A. So this B minus the value in A, that's going to give us the NPV. It's a positive NPV in this case. So what do you do? Accept or reject the project. Meantime, I'm just going to check the answer as well. Hope the calculations are correct in this case. So my NPV is coming to 11,988. It is perfectly correct. So I think in the book it's 11,988. We're getting a slight difference of almost 8 rupees. That's fine. So since the NPV is positive, we will say it is to be accepted because the NPV is positive in nature. So that was a comprehensive question, giving you the calculations on the NPV stuff, where we just look at the organizing data on a step-by-step approach in this case. Okay, I have got, more questions which we're going to do on a lease and buy as well. And we're going to do some more questions pertaining to the concept of, the equated NPV concept as well. Okay, so this is done. But before that, I want to pick up the second requirement also, just to discuss it quickly. It says discuss how the capital asset pricing model can assist HABAC in making a better investment decision with respect to new product launch. Now, my question is, let's get the input from your side. When it says that a CAPM model is going to help you in making a better investment decision, what is he trying to hint at? What kind of comments are you going to make in terms of, the part number B for 8 marks? So let's get that input from your side. So what kind of comments do you think is he expecting that, a CAPM model is going to help you to make better decisions? What is the thought process? That's absolutely correct. I think the hint is towards, making a mention that the company is entering into a new product launch. So you need to be careful that, do we need a risk adjusted, discount rate or not? Because CAPM model will help you to get an adjusted equity risk factor. What we were discussing yesterday in terms of the 3-step that you ungear, get an asset beta, then you regear and you get an equity beta, and then you apply a CAPM model in terms of calculating a risk adjusted cost of equity. So I think you need to give a good insight to the examiner that considering that there might be a business risk and there might be a financial risk, we need to consider an appropriate beta factor and then convert it into a cost of equity, which is a risk adjusted equity. Good. I think that was a good input. I wanted that insights as well. Okay, now I think let's go to the next area. So let's now pick up another question for you. I guess now I'm going to take another question. So maybe we can first take a question which is based on yes, we're doing a sale and lease question, I guess. So first, I think we'll talk about sale and lease, a simple question. But before that, let's, I think, conceptually, first of all, discuss the agenda. So let me, I think, first discuss the concept, then we'll go further. Now, the idea is now to discuss what happens on a lease and what happens on when you are considering taking it on outright purchase. So we are now looking at buy versus lease. We're now looking at decisions for buy versus lease. Now let's first, I think, conceptually make a quick revision in terms of buy versus lease, that what kind of considerations should go at the back of the mind. Now, let's first consider that if you're considering a buy option. But first of all, let me ask you a question. What is the discount rate at which you will evaluate this decision? I think let's first get this from your side. When you're evaluating a buy versus a lease transaction, so what is the discounting rate we need to consider? Right? Can I say if you would have taken a loan, you would have paid certain interest rate. So we should take the interest rate on that loan post net of tax. That's right. So when you're going to consider this, we will consider, you can say a post tax, you can say cost of debt. He will tell you in the question that if you would have taken a loan, there would have been a certain interest rate which would have been paid. So we need to consider that rate converted into a post-tax rate. This is one basic input. Now let's consider buy. So in terms of buy, I think the first consideration which comes to the mind is, are you going to take a loan or are you going to consider cash outflow at time zero? Because many times the question tells you that you're going to buy the asset and take a loan. So are you going to literally take a loan or are you going to consider that you paid for the asset at time zero? And that's right. So not considering, we are not considering a loan. So we will consider an outright purchase for our evaluation. So when you consider in this particular case, so when you consider the evaluation of a buy option, one thing very clear, do not get trapped into the fact that he gives you a loan. You just need to consider that we're going to pay everything at time zero. Now let's evaluate all the inflows and outflows which will occur in this decision. So let's begin with the list of cash outflows. Now start telling me what are the cash outflows you're going to consider, right? One is the purchase cost, and that would be at what point of time? Time zero. Great. Any other cost which needs to be considered? You're going to purchase the asset, that is a cash outflow at time zero. Any other outflows which will occur in this case? Yes, there can be a maintenance cost as well. That's right. So there could be a maintenance cost as well. I agree. Anything else? Or can I say typically this will be the only cost which will happen? And then I think we can take the cash inflows. So in terms of cash inflow, can I say there will be a tax saving on depreciation, right? There will be a tax saving on depreciation. And be careful. Be careful in this particular case when you say that there is going to be a tax saving on depreciation. You need to be careful that whether it is in arrears or not. Because if it is in arrears, then you need to consider the timing factor for the tax saving on depreciation very carefully. And any other inflow which will be there, can I say there will be a terminal value? That's right, a scrap value. A terminal value will be considered, and this will also be net of tax. But you also need to consider that in this particular case, if the tax is in area, consider the terminal value separately and consider the tax effect separately. Okay, so mainly I would say these are the outflows and inflows in terms of a buy option. You buy the asset, then there is a tax saving on depreciation. So we can say if it is not in arrears, it's going to be starting at the end of first year, otherwise it gets delayed. Okay, now let's consider what will happen in terms of a lease option. What will be the cash outflows in terms of lease option? And what will be the cash inflows in terms of lease option? So if you consider the cash inflows and outflow, the lease payments will be taken, and generally, unless mentioned otherwise, can I say the lease payments are always paid at the beginning of the year? So lease payments will be the outflow, generally paid at the beginning of the year. Generally paid at the beginning of the year. So generally we pay them at the beginning of the year. And inflows will be, can I say, the tax savings on the lease payment. The tax savings which will come on the lease payments, that would be an inflow, because this will generally occur at the end of each year. So this will generally be at the end of each year, because you might pay the lease rents at the start, but the tax saving is going to come at the end of each year. And I think another very important input is if there is a common inflow or outflow. If there is going to be a common inflow or outflow pertaining to these options, will you consider that? Or will that be simply ignored? And that's right. So I think let's put a note across what we need to keep in mind, that if there is any common inflows or outflow, if there is any common inflows or outflows for both the options, so if there is any common inflow outflow for both the options, it will be ignored. Because in this case, we are not going to consider any common inflows and outflows. That will stand ignore. Wonderful indeed. So I think that gives us the inputs. So do we consider maintenance cost in case of lease? Well, if the maintenance cost is supposed to be, common to both the buy and the lease, because if you buy the asset, you maintain it, and if you lease the asset, you still maintain it, then it will be ignored. Unless the question explicitly tells you that this cost will not be incurred in terms of lease, then you will take it in the buy option and not in the lease. But if the question says that the maintenance cost will be incurred irrespective you buy, irrespective you lease, then it stands ignored. Okay, so all set. I think this is done. Now I think we can do a question on this area. Okay, so I think let's now share a question to you on the screen. And let's have a look at this question. So see, have you done this question? So is this question new? Done this question? Yes. Oh my God. We are doing all questions what we have done. Okay, anyway, not an issue. That will only help us to do the calculations faster, I believe. Okay, so I think let's read the inputs out here. Let me first read. The worst part of the question is that the taxation stands ignored. Oh my God. Now it says, assume that the new machine is operated for a 3-year period. Evaluate whether we should lease or borrow as a source of finance. So let me just take an input on the details given in the question. It says Mellin Company is considering acquisition of a new machine with an operating life of 3 years. The new machine could be leased for 3 payments payable annually in advance. Alternatively, the machine could be purchased using a bank loan at 8% per annum. If the machine is purchased, you will incur the maintenance cost payable at the end of each year. The machine will have a residual value at the end of 3 years' life. Then he says, Mellin Company's production manager estimates that if the maintenance routines were upgraded, the new machine could be operated for a period of 4 years, with the maintenance cost increasing to 12,000 per annum, payable at the end of each year of operation. If operated for 4 years, then the residual value will fall to 11. Now, I think in this particular question, he did not make a mention that if you take a machine, then you're going to incur any maintenance costs. So I think in this case, it is logical to presume that maintenance cost will be incurred only if you purchase the machine. It will not be incurred if you are going to buy the machine. If you're going to lease the machine. So in this particular case, we will definitely consider the maintenance cost in the purchase option, but not in the lease option. Okay, so let's, I think, organize the data. This is my question number 2. This is on lease versus buy. And the question has already told us that we are ignoring any taxation effects. So I think let's first consider the buy option. And let's organize the data. Particulars. The headings would remain the same, what you take in NPV statement. Time. And let's consider PVIF. Then there is amount. And then there is present value. And in this particular case, you will always get a net outflow. You're never going to get a net inflow because these decisions are based on a total outflows. So I think we'll just take the outflows without the brackets, and we can take the inflows with the brackets. So all the outflows will be taken without the brackets and all the inflows will be taken in the brackets. So let's begin with the data on the purchase. So it says the machine is going to be purchased at 160, but before that, let's get the discounting factor. Can I directly take it as 8%? I'm not given any tax rate in the question. So since we're ignoring a tax rate, so can I say the 8% bank loan interest itself becomes the discounting rate? So I think we'll just make a mention, the discount rate. So the discount rate in this case is supposed to be 8% flat. Okay, so let's, I think, organize the data. So there is going to be a purchase cost. This will be times 0, P factor 1. And what is the cost of the asset? So 1,60,000 is the cost of the asset. So you get the present value also 1,60,000. Okay, let's see the other inputs. So I am given the purchase or the cost is done. Then there is a maintenance cost payable at the end of each year. So let's take the maintenance cost. So maintenance cost will be taken at what timing factor? So right now we're considering the life is 3 years. So can I say the maintenance factors will be what timing factor? Is it going to be 1, 2, 3? Because it's payable at the end of each year of operations. So what's going to be the timing factor? 1 to 3, right? Yes, of course. So this is going to be 1, 2, 3 years. And let's see the cumulative factor. So at 8%, if I look at the cumulative factor, I think it's 2.577. So the maintenance cost which we are incurring is to the extent of 8,000. And there is no tax impact. So we can take this directly 8,000. So we multiply, get the present value. And next, so I think the purchase cost is done, the maintenance is done, and then there is an inflow, which is the terminal value at the end of 3 years. So there is a terminal value. This is at the end of third year. So P factor at the end of third year is, I think, 0.794. And this is going to be inflow. So we'll take it in the brackets. So we're going to sell the machine at 40,000. And any depreciation relevant? Any tax saving on depreciation relevant? The tax stands ignored. So I think if the tax stands ignored, the depreciation is irrelevant. We're not concerned. So let's take this 40 into the present value factor. I think that's it. There's nothing else which is given in the option, I guess. The outflow is done, the maintenance purchase cost done, the terminal value is done. We can now get the total present value. So let's see what is the total present value in this case. So this is the present value of cash outflow. This is the present value of cash outflows. Okay, so this is the buy option. Now let's go on to the lease option. Let's go to the lease option. So in terms of the lease option, can I say there is only one outflow, which is supposed to be what? The lease rent. So we can consider the lease rent in this case. And this is again going to be 1 to 3 years. The P factor is 2.577. And what is the amount of lease rent we are paying? This is payable in advance, I'm afraid. So if this is payable in advance, yes, we need to change this from 0 to 2. That's right. It's payable in advance, 0 to 2. Correct. So this is going to be 55,000. This is the only outflow. So let's change the factor, 2.783. So we take this 55 into the factor. Okay, so I think this gives me the present value of the cash outflow. So present value of cash outflows in this case. And that works out to be the same figure. So what is the decision? Are we going to prefer buy or are we going to prefer a lease? Wherever the outflows are lesser, we prefer that particular option. So buy is a better option. That's right. So we will say that buy is better. Wonderful indeed. So this is the input in terms of lease versus buy. Now this question has got another requirement as well, which is on the equated concept as well. Let me first check the answer if this is correct. So 148,856, that's right. And the other one is 153. That's absolutely perfectly right. Okay, now we need to do the second part of the question, but I think before that, I think maybe give you a break. What do you say? Let's give you a break and then we can do, one question on this area. Another question which I'm planning to do is on the area which is on the area which is expected NPVs and all, where we consider the techniques of probabilities and all. So shall we give you a break first and then start with the EAC concept, and then we go to the concept of the probability factor? Shall we give you a break at this stage? Okay, I presume yes. So let's take a break. I'll join you in 10-12 minutes time. We'll start back again. Enjoy your break. Right, welcome back. I guess good to start. So we'll go to the next requirement of the question, same question, where we're looking at the second input. So in the second part, it says using a discount rate of 10%, calculate the equivalent annual cost of purchasing and operating the machine for 3 years and 4 years and recommend which replacement interval should be adopted. So we now need to find out that what is the replacement interval, 3 or 4. So I think the 3 years data is already there with me. So let's now consider the replacement part. So we've got two options. One is that we replace after 3 years, and the other one is we replace after 4 years. So can we take this data, what we have computed above, for the purpose of our calculations? What do you say? When it says using a 10% discount rate, so can I use this particular data, what I've done above? Just a little observation. So is it good that we can pick up the present value of cash outflows, which we've done, just pick it as it is? Or is there any danger in terms of doing that? Any observations? So we have done the calculations already. When you buy for a period of 3 years, can I take the data as it is, or is there any challenge in terms of that? And that's right, we can't. And what is the reason we can't? Because the percentage of discount rate is undergoing a change. So therefore, we will have to pick up the data but change the discounting rate. So at least let's do one thing. Let's copy this. And we can just, change the discounting rate in this case. So we replace after 3 years. So we need to consider a discount rate at the rate of 10%. So I think this is replacement after 3 years. So purchase cost would remain the same. Maintenance cost, we need a new P factor. So let's see what is the present value factor now at 10% for 3 years. I think this is 2.487. And the terminal value at the end of third year, the factor would also undergo a change. That's 0.751. Okay, so I think this takes care of the input. Now tell me, what am I supposed to do? Once you've calculated the present value of cash outflow, since you need to compare a 3 years and a 4 years replacement, so what am I supposed to do? Convert this in terms of equivalent annual cost, correct? And for this, you need to divide it by what? If I want this PVIFA, that's right. So let's divide this by the PVIFA. So we can divide this by 2.487. So we'll get this total value divided by the factor, and that comes to 60,255. Okay, so I think this takes care of the first requirement if you replace it after a period of 3 years. I'll just make the check on the answer as well. So if you replace this, I think that is perfectly fine. Okay, now let's go to the replacement after 4 years. So we can still use this data. We'll just make the changes. We'll just copy this. So if you replace after 4 years, so if you replace after 4 years, the data will slightly change. So purchase cost will not change. Maintenance cost, I think he said, is going to undergo a change. It says the maintenance manager said that if you're going to use the machine for 4 years, the maintenance cost will be 12,000 per annum payable at the end of each year. So this will change to 12,000. And we need a 4 years factor now. So let's see what is the 4 years factor. So 1 divided by 1.1, that's 1, 2, 3, 4. This is 3.170. And this will also be at the 4th year. I think this figure is also changing. The terminal value will come down to 11,000. And let's get the factor. 0.683. So I think this is done. Anything else we've left out, or is this correct? Just the P factor needs to be changed. So this is going to be 3.17. Okay, so I think this is done. So the equated annual cost in the first one is 60255 and this is 60103. So which option is better? Replacement after 3 years or replacement after 4 years? So replacement after 4 years is a better option because then the equivalent annual cash outflow is lesser. Okay, great. Though there was no tax rate, I think without the tax rate, I think the intensity, of course, goes a bit down, but that's fine. Okay, now I think let's go to the next agenda. You want me to do another question which is comprehensive of NPV, or you want me to do something which is on the probability factor? Because I think maybe you've already done that probability factor as well. So what do you want me to do? Another question on inflation part? Probability one. Okay, let's go to the probability one then. So we'll look at a question on the probability part. This we have done. Okay, this is the initial part is, I think, the initial part of the question, I think I missed it out. Just give me a second. I think I'll just share it on the screen. My initial part of the question is gone. Yes. On the probability factor, copper company. Just a minute. I think I missed out that particular question. Okay. I'll just share that question to you. Just wait a minute. Just a second. I'll just share it on the screen. Right. I'm sharing the question on the screen. Let me know if it is visible. This is the question, copper. Have you done this question? I guess yes. Every question done? Yes, very good. Then what's the new in this question? But still, let's do it. I think we'll just quickly revise the concept. So it says copper company is concerned about the risk associated with the proposed investment and is looking for ways to incorporate the risk for investment appraisal process. It says the company had heard that probability analysis may be useful in this respect. So the following information relating to the proposed investment is being prepared. Now we've got a cash or cash flows, year one probabilities and cash flow year two probabilities are given. However, the company is not sure how to interpret the results of investment appraisal based on the probability analysis. The proposed investment will cost 3.5 million payable in full at the start of the year, and Copper uses a 12% discount rate in investment appraisal. Now, the requirement is very clear using a joint probability. It says we need to calculate the expected NPV. Then he says calculate the probability of investing having a negative NPV, calculate the NPV of the most likely outcome, and comment upon the financial acceptability of the proposed investment. Now, I've got a quick question to ask you. Let's say if the requirement number 234 is not there. Mind the question. Let's say if the requirement number A234 is not there. Can I simply take a weighted average cash flow for year one and a weighted average cash flow for year two? If the requirement number A234 was not there, can I directly consider a weighted average cash flow for year one and two? Yes, we can. But in this particular case, considering that you need a probability of a negative NPV and you need the NPV for most likely outcome, I think we need to look into all the permutations and combinations. So tell me how many permutations, combinations are going to be made out of this data? Because year one, the cash flows could be either 10 lakh, and then you will have in year two any of the three. That's right. So you can take year one, that is 10 lakh, then there could be year two, either 20 or 30 or 50. So that will make us a total of 9 permutations combination. So am I supposed to calculate the NPV for all these 9 combinations separately? And then consider the joint probability? Yes, that's what the marks are meant for. So 8 marks is meant that you are going to calculate 9 NPVs, joint probabilities of all the NPVs, but then we'll be able to answer the next requirement easily. Let's, I think, begin the inputs then. So we'll first organize the input. So this is my next question. That is the question number 3 for the day, which is based on the concept of technically a joint probability. So this is on the concept of a joint probability. So let's first organize all the permutations and the combinations. So let's see the permutations and the combinations. So we'll first identify all the permutations and combinations in this case. So let's begin with combinations. I'm looking at 1. Then I think we'll organize the data out here. Combination 1, there is a cash outflow, and then there is a cash inflow. And I think we can organize this. The cash outflow will be 0 point of time, inflow will be first year, inflow will be second year. And I can just organize the input. We can get the NPV. It's shorter way to, let's first get the joint probability. Or let's make a little better format. I think since we need a discounting as well, let's make a little better format so that we can get everything together. So let's do one thing. Let's consider particulars, and then we can consider the cash outflow, which is already in present value terms. So the cash outflow is already in present value terms. Then we can take cash inflows, and we will take year one, we will take PVIF, and we get the present value. Then we can take the second year PVIF and the present value. So I'm just organizing the information clearly. So, and then we can get the NPV directly out here itself. So we can calculate the NPV. So this is my present value and this is my NPV. Okay. So I think I'll take this as A. I'll take the cash outflows as A, and the inflows, I'll take this as B. I'll take this inflow as C, and the NPVs I'll take as B plus C minus A. Just presenting the answer so we can get quickly the results. Now let's organize the data, and I think we need one more column, and the other column which we need is on the joint probability. So we'll get the joint probability also and get the NPV. Let's take the joint probability, I think later. I'll take that in the separate column. So let's paste this here. Let's get the joint probability and then get the weighted average. Right. So now let's consider the data. It's more, clerical in nature. So let's just organize the input. Now let's look at the permutation combination one. So we're looking at combinations. So the combination number one, let's consider first of all the outflow. So what is my outflow? Can I see the outflow is given to me? It's 3.5 million, so 35 lakhs. So the cash outflow is 35 lakhs. This will remain the same for all the combination. Now let's look at the first combination. Can I see inflow of 10 lakhs and 20 lakhs? Inflow of 10 lakhs and inflow of 20 lakhs. And let's also get the discounting. So what is the discounting factor? The discounting factor is 12%. So let's see what is the factor at 12%. That's, I think, 0.893. And let's see the factor for the second year. That's, I think, 0.797. So we can get the present value, this into this. And we can get the present value, this into this. And let's also see what is the joint probability. So can I say what will be the joint probability? It's 10% for year one and it is 30% for year number two. So what is going to be the joint probability? Can I say 3%? So this is going to be joint probability. Let's put it as 0.03. Weighted average we'll see later. Now let's see the NPV. So can I say NPV is going to be the sum total of, you can say this cell plus this cell and minus this cell. I hope the figures are correct, right? So I've taken the sum total of the inflows for the year 1 and 2 minus the cash outflow. Now we're going to do combinations like this only. 2, 3, 4, 5, 6, 7, 8, and 9. So can I say this would remain the same, right? So this remains the same. Now let's go for the next permutation combination. So first, I think we'll finish the year 1 to 2. So it's going to be 10 and then 30 and 50. So this is going to be 30. And this is going to be 50. So once you organize the data, then it's an easy exercise. So this will remain 10 lakh. So I guess we can get the second factor. This is of course same again. So this remains the same. And this factor would remain the same. So let's get the present value. Okay. And then let's get the NPV as well. Okay. So that's great. And now let's see the joint probability as well. So joint probability for the second combination, I think let's get the answers from your side. So what is the joint probability for the second combination? 0.1 and 0.6, that's 6%. That's right. So this is going to be 0.06. And the joint probability for the next combination is, that's 0.01. Correct. So this is done. Then now let's go further. Now let's see the next combination. It's going to be 20 lakhs in the first year. So this is 20 lakhs. And we can copy this data. Let's copy this out here. And this will remain 20 lakhs. And this would remain the same. And this would remain the same. And we can get this values as well. And we get these values as well. And we can also get these values as well. Okay, that's fine. So this is my NPV coming positive all throughout. Let's see the joint probabilities as well. So NPV is incorrect. Oh, so I think let me just check this out. NPV is going incorrect. Let's see. This was G35 and plus J, that is 35 minus E. But this is correct, I guess. The present values are correct, I guess. This is the present value for the inflow in the first year. This is for the second year. I think it is coming correct. Let's still see. Yes, I think the NPV is got some problem. So I guess we've got the factor 0.983, that is right. And the figure is, so where is the mistake? 3500 is not subtracted in the cash inflow. Okay, let me do one thing. Let me just recompute the NPV. So I think this calculation is right. Now let's see the further input. So we can take the sum total of this plus this minus, yes, I think now it is right? Formula depiction error. Yes. Yes, now we got the correct answer. Okay, so now let's also get the joint probabilities as well. So this is going to be 0.5 into 0.3. Yes, now it is fine. So now we get 0.5 into 0.3, that is 15%. The next one is supposed to be 30% and 5%. That's 30% and that's 5%. Okay, now let's go to the next data. Now the next permutation combination is 30 lakhs. So this is going to be 30 lakhs. And we can take this, stretch it out. This figures would of course remain the same. And we can get this data as well. And this would remain the same again, 20, 30, 50. This remains the same combination, 20, 30, and 50. And this would remain the same. We get the present value. And I think we can get the NPV as well. Okay, now let's see the joint probabilities as well. So joint probabilities, now we are given it's 12%, 24%. This is 12%. That is 24%. And this is going to be 4%. We should also ensure that the sum total of the probabilities should be equal to 1. Because if that matches, that means the answer is correct. No, this is not. Oh. Let's see the sum total of the joint probabilities as well. Yes, it is coming to 1. So that means the answer is correct. Okay, now let's look at the input. First, we need an expected NPV. So can I say to calculate the expected NPV, we should multiply the NPV into the joint probability. And then we can just take the figures as it is. And let's take the sum total of this. So I think this is my expected NPV. That is 865,200 is the expected NPV. Now this is answered only the first requirement of the question. So now let's, I think, go further. So the first requirement is done. Using a joint probability table, calculate the expected NPV of the investment. That is done. Now it says what is the probability that the NPV will be negative. So you tell me what is the probability that the NPV is going to be negative. So can I see, we can see the negative NPVs if I mark them. These are the two negative NPVs. That's 1. And then there is another negative NPV. That's 3. So you can add the probabilities of these 3. Add the joint probabilities of these 3. So if we add the joint probability, it comes to, yes, 24%. So we can say for a negative NPV. So for a negative NPV, we can say the probability is supposed to be 24%. Right. So this is another input. Then it says calculate the NPV of the most likely outcome. So which particular one has got the highest probability of occurrence? So I guess the highest probability of occurrence is what? The most likely one, I guess 24% again. So it says what is the question says that what is the probability of the most NPV of the most likely outcome? Oh no, this is 30%, right? Yes, it is 30% is the highest probability, correct. So we'll see the highest probability. So highest probability in this case is 30%, and the NPV at 30% is supposed to be, that comes to 2,03,100. That is the NPV. So I think that answers the next requirement as well. So probability of a negative NPV done, 24%, NPV of the most likely outcome done. And then it says comment upon the financial acceptability of the proposal. Overall, there is a positive NPV. So what do we do? Financially viable? Of course, yes. It is undoubtedly financially viable. It's a positive NPV. Since it is a positive NPV, it is undoubtedly viable. Right, so I think this takes care of the joint probability concept as well. So I think we've done variety of investment appraisal questions. I have covered with you the areas of joint probability, covered the area of inflation, and we've also covered the inflation of lease and buy and the concept of equated annual cost as well. Okay, you want me to do another question now on inflation because I've covered all other aspects. So tell me, what is your choice? Anything specific you want me to cover, or shall we do another question on the concept of inflation? Or the other option is buy versus lease with a taxation. Okay, then I think let me share a question with you on that. I have not selected a question on that area. I'll take that. Just give me a minute. Okay, let me just share a question to you on this area. Just a minute. Okay, we'll take a small little question on this where there is a tax rate involved as well. And with the tax in areas as well. Okay, got the question. Though this question also you would have done earlier, but I think we'll still do this. Okay, let me share this on the screen. Risk management sums. Forex, you mean to say? Forex, we did one of the questions yesterday. Actually, section C, we don't get questions on Forex actually. So I didn't do too much questions on the Forex area actually. Okay, let's have a look at this question. It says a firm decided to acquire a new machine to neutralize the toxic waste produced by a refining plant. The machine will cost 6.4 million and would have an economic life of 5 years. It says the tax allowable depreciation 25% on WDV is available on the investment. Taxation of 30% is payable on the operating cash flows 1 year in arrear. The firm intends to finance the new plant by means of a 5 year fixed interest loan at a pre-tax rate 11.4% with a principal repayable in 5 years' time. As an alternative, a leasing company proposed a lease over 5 years, 1.42 million per annum payable in advance. Scrap value under each alternative will be zero. Evaluate the two options, acquiring the machine and advising the company on the best alternative. So I think in this particular case, we need to first of all consider that what are the inflows, outflows for a purchase option. So can I say in terms of purchase option, there will be number one, purchase price. Can I say number two, there will be a inflow tax saving on depreciation. Can I say that's it? So if you look at the inflows and outflow, so can I say the outflow is the purchase cost of the machine at time zero? And the inflows will be the tax saving on depreciation, which is going to be different for every year because my depreciation is on a WDV. So you'll have to calculate a tax saving each year separately. And in terms of the lease option, there will be just a lease rent paid and there will be a tax position net. I think let's begin the journey. So this is the question number 4. That is on again lease versus buy. So first, I think let's organize the buy option. There are a lot of inputs to be computed. So buy option, we'll just organize the statement particulars. Then there is time. Then there is PVIF. Then there is amount. And then there is present value. So first of all, we need to consider the purchase cost. So as far as the purchase cost is concerned, times 0, P factor 1. Okay, first tell me what is the rate at which a discounting will occur. I'm given a pre-tax cost of debt is 11.4% and we're given a taxes at the rate of 30%. So can I say convert it on a post-tax basis? So we can just organize what is the discount rate. So my discount rate in this case is going to be 11.4% net of tax. That's going to be, I think, approximately 8%, I guess. If you consider the discount rate, I think it's coming approximately 8%. 11.4% net 70%. Yes, it is 8%. Okay. So now with this, we can get the amount. So what is the purchase price? You are going to buy the machine at 6.4 million. That is 64 lakhs. So this is the cost of the machine. The present value is 64 lakh. Now, the only inflow we need to consider is the tax saving on depreciation. And this is going to be for how many years of time? The plant has got a life of 5 years and we're using a 25% WDV. Okay, I'm just thinking now, are you going to consider a depreciation for 4 years or are you going to consider depreciation for 5 years? Though it says the scrap value of the machine is going to be zero under each financing alternative, but when we are going to consider a depreciation, we're going to consider 4 years and consider a balancing allowance or charge separately. So I think let's make a working note. I'll make a separate working note for that. So this is regarding the computation of depreciation. So let's see the computation of depreciation in this case. So we can take the depreciation for the year. So we have got depreciation for the year number 1, 2, 3, as well as 4. We are not considering depreciation for the 5th year. So let's first organize the depreciation for each and every year. So cost is 64 lakhs. We've got a depreciation that is 25% WDV. So 25% depreciation would mean 16 lakhs in the year 1. And you can take 75% of this. That comes to 12 lakhs. Then again 75% of this, that comes to 9 lakhs. And then again 75% of this, that is 6,75,000. Okay, this is the figure of depreciation. Then we can take a tax saving on account of this. So my taxes, I think at the rate of 30%. So on the depreciation, 30% would mean this into 0.3. So that will give me the tax saving on the depreciation. I think let's do one thing. Let's do the discounting also at this stage. So we take the PVIF and get the present value as well. So let's see what is the PVIF at 8%. So that's 0.95926. Then it is 0.85857. Then it is 0.794. And then it is 0.735. So we can take the present value. This is 480 into 0.926. So this will give us the present value as well. So we can take the present value of this. The sum total, this comes to the tax saving on depreciation. Oh, taxes in area. Oh my God, I just slipped out of the mind. So I think the taxes in areas, what we'll have to do in this particular case, shift it 1 year. So we'll shift it 1 year. 1 divided by 1.08, 1, 2, 3, 4. This is 0.680. 0.681, I would say. So since it is in areas, let's do one thing. We'll shift all this data by 1 year. And now we can multiply this. So this into the present value factor. So this is going to give us the tax saving on the depreciation in arrears. Right, I hope this is correct now. So this is the tax saving on depreciation in arrears. This is on the depreciation computation. Now we need the another working note, and that is going to be on the balancing allowance or the balancing charge. So we take this on the balancing allowance or the charge. So for this purpose, again, we need to first calculate the capital gain or loss and then take the tax in arrears. So let's see what is the book value of the asset. So the cost of the asset which we purchased was, I think, 64 lakhs. And we had taken a depreciation for the first year. I think it was 16 lakhs. Then for the second year, it was 12 lakhs. Then it was 9 lakhs. And then it was 675. So this is the depreciations we have taken. We can get the book value of the asset. So the book value of the asset is 20,25,000. Okay, so this is the book value. Is there any sale proceeds of the asset? This is nil. There is no sale proceed. So that means we will get a balancing allowance or a balancing charge. So there will be a balancing allowance. So we'll take the balancing allowance. It's indirectly a capital loss in this case. So this comes to the same figure, 20,25,000. And on this amount, there is going to be a tax saving. So tax saving was at what rate? 30%, right? Taxes at the rate of 30%. So on this amount, we take a 30% tax. So this is going to be again in arrears. So we'll get the advantage 1 year later. Let's, I think, fit this out. So tax saving and depreciation, we can fit this directly in the statement. So this is the tax saving on depreciation. I think I'll take it in the brackets. Let me put it in the brackets. This is 10,33,552 because that's an inflow. And then there is going to be a tax saving on the scrap value as well. That's, I think, going to be 1 year in arrear. So life of the asset is 5 years. So this will go to which year? 6th year, I guess. Because the asset will be having a tax saving and this will go to the 1 year in arrear. That is 6th year. So let's see the factor in the 6th year. So 6th year factor would be at 8%. 0.631, and we can get the present value. The amount is supposed to be, we have to fit it out here. So the amount of tax saving is 6,07,500. This is 6 lakh. This will also take it in the brackets. 6,07,500. So we get the present value, this into the factor. I think that's it. We'll just make a scrutiny if there is anything else. So I think the asset cost is done, the depreciation is done, and I guess the terminal value tax savings are done. So we can get the present value of cash outflows. This comes to a total of 49,83,116. Now this is as far as a buy option is concerned, and now we'll go for a lease. So as far as lease option is concerned, there will be two things, lease rent and there will be a tax. So let me take this headings itself. So for the lease one, we just have two inputs. So one is the payment of lease rent. The payment of lease rent will be at the beginning, I guess, advance. So he's given me that as far as the lease rent is concerned, we're going to pay this 1.42 million in advance each year. So what will be the timing factor of this amount? So 14 lakh 20,000, this is going to be what timing factor? 0 to 4. That's correct. So this is going to be taken at timing 0 to 4. So let's see the PV factor, and this is going to be 1.42 million, that is 14 lakh 20,000. So let's see the PVIF at 8%. 4.312, I guess. That's right. So this is 4.312. So this will be into the P factor. And then there is going to be a tax saving. So what will be the timing factor of the tax saving? Can I say it is going to be 2 to 6? Correct. That's right. So this is going to be 2 to 6 years. That's right. So let's take 2 to 6 years. So this is 2 to 6 years. Let's see the factors. So on 1420, we take a tax advantage at the rate of 30%. This will be inflow. So that's going to be 4,26,000. Now let's get the PV factor 2 to 6 years. You need to take the sum total of 6 minus the sum total of 1. So let's see what is the PV factor. One to 6 minus 1 year. So 1 to 6, that is 1, 2, 3, 4, 5, 6. 4.623, 9 to 6. So anybody is computing this? 3.697, is it? Yes, 3.697. So this is 3.697. So we take the present value of this and we can get the total outflows. Okay, wonderful. So we get the sum total of this, and this is coming to 4548. So your outflow in terms of the purchase option is 49 and this is 45. So what is a better option? Lease. Lease is going to be a better option. The outflow is lesser in that particular case. Okay, wonderful indeed. So I think this is done. So I think we've done a question on a lease with a taxation effect as well. I think now many people are getting tired as well. I think that seems to be good for the day. That's what I feel. Most people feeling very, very tired indeed. I think I've gone on a good pace, I guess. Right. So I think all the agendas are done. I think that's all what we have for the day. So I think now you can revise things and all. Probably the doubts will be taken in the later session. So I think we've covered whatever section C questions we could have done. So I think let's call it a day. Unless you've got anything more specific to ask. Otherwise, I think let's call it a day. Right, friends. So I think that's all for the day. Thank you for joining. Bye bye. Take care. Wish you all the best for the exams. Thank you.